Hi, in this video I will cover the flag chart pattern, which can be either bullish or bearish, but I will mainly focus on the bullish flag pattern. If you are not yet completely familiar with the flag pattern or you want to refresh your knowledge, I will put a link in the description to an article where the pattern is described in detail. So let me give you a quick overview of the items covered in this video. So how to screen the bullish and bearish flag pattern in ChartMill, the importance of volume and momentum, some distinctive characteristics of the flag pattern, and how not to trade this pattern, how it's done properly for swing and trend trading, position and stop loss management using our ChartMill's position sizing tool, how to take advantage of this bull flag pattern as a day trader, some ideas on where and when to exit, and to conclude, some final thoughts. My name is Christoph, enjoy the video and welcome to ChartMill. So ChartMill is able to scan for the presence of bull and bear flags. To do so, go to the stock screener page and select the indicators section from the menu. You can filter on both the daily and weekly chart by the bullish or bearish flag pattern. ChartMill even allows you to filter by the length of the pole and both the length and width of the flag itself. If the flag pattern isn't visible on the chart, select the main chart, click on the blue plus sign, and via Select Overlay to Add, choose ChartMill Flag from the drop-down menu. Now, keep in mind that these are all automatically generated results, and certainly not all of them are perfect. The screener provides an initial basic selection of stocks that exhibit characteristics of a bullish or bearish flag pattern, but further manual selection is required to withhold only the best setups. The trading strategy in this video is based on a breakout from the bullish flag pattern and can be applied to any time frame, whether it is a 5-minute intraday chart or a chart where each candle represents a full trading day or even a full trading week. The principles remain the same. Just keep in mind that automatic screening for flag patterns is only possible on the daily and weekly chart. Now, I really want to draw attention to some important aspects that are often overlooked when people talk about bearish or bullish flag patterns. You will come across these patterns quite often on all sorts of charts, but if you follow the guidelines given in this video, you will quickly realize that very few of these flag patterns really meet all the conditions that are needed to be considered true low-risk setups. Volume and momentum are the most important characteristics when trading flag patterns or any other pattern. The pattern itself is only an indication. It gives us a potential low-risk setup. Momentum says something about the speed and force with which the price moves, but it says nothing about the direction the price is going. Momentum rises as price surges higher or tumbles down. Volume has everything to do with the amount of shares that change hands. This can be measured over a single day or over a longer time period. When rising momentum and bigger volume occur together, this is important information for the technical trader. After all, you are dealing with a price movement which is gaining in strength, momentum, and at the same time more and more shares are changing hands, volume. This degree of volatility, combined with technical patterns and sound risk management, offers attractive opportunities to investors. Not all flag patterns are suitable for trading. Check out the bullish flag pattern in the chart of Entravision Communications. For a bullish flag pattern, we are looking for a strong preceding rising trend with clear consecutive large candles, rising volume, and a closing price for each candle close to its highest price. This tells us that there is considerable amount of momentum. After this first price climax, price drops slightly. At this stage, there should be absolutely no question of an explicit sharp decline, as we want to avoid that kind of downward momentum. It's rather a sideways movement. In the most ideal circumstances, the candles are quite small and there are several tails visible at the bottom and at the top of the candles. This is the ongoing price action that forms the actual flag of the pattern. This pause after the initial strong rise is triggered by those who bought the stock early and are now taking advantage of the strong buy momentum to partially sell long positions. The moment the actual breakout occurs is when new buyers step into the market. Let's take another look at an example for carat X. Again, long white candles and rising volume during the preceding uptrend, narrowing candles on lower volume during the consolidation phase, and finally a volume spike at the moment price breaks out of the flag pattern. As for a bearish flag pattern, the same principles remain valid. See this example of a bearish flag pattern in Stanley Black & Decker. Narrowing candles during the consolidation and a clear volume spike during the breakdown candle. The most common mistake is trying to anticipate the breakout move. As the candle forms and explores the outer limits of the flag pattern, a long position is already taken on the assumption that the breakout will occur. Unfortunately, no one can predict the future with certainty. A price candle that penetrates the upper boundary of the flag in no way gives any certainty about the closing price of that candle. Let's take a look at the daily chart of select interior concepts. All the elements necessary for a valid bullish flag pattern are present. A strong increase with high volume and considerable momentum, followed by a sideways, slightly declining trading range which forms the actual flag. Now, suppose we set a buy stop order at 11.50, assuming that if prices reach that level, the flag pattern is no longer valid and price will definitely move higher. The stop loss is positioned just below the flag pattern. This is what happened at the end of the trading day. The breakout from the flag pattern proves false. At the end of the day, the price still closed within the flag pattern, which again invalidates the setup. However, by entering the market too quickly, we are now stuck in a long position which suddenly looks far less attractive. Not only it appears to be a false breakout, but on top of that, a bearish doji candle has just been formed with a long upper tail at the top of the trading range. As you can imagine already, barely 3 days later, this long position would have been stopped out. On Monday, September 10th, I had ChartMill run a scan for a bullish flag pattern using the following filters: exchange US only, price above 20, average volume more than 300k, no ETFs, and a bull flag pattern recognized by ChartMill. With these filters, ChartMill showed me 112 candidates, and to further refine these, I then added another price filter: price versus SMA, price in 5% range of SMA 200. So I ended up with only 7 results. I have set the historical date to the 10th in the screener, so these results are exactly the same as on the 10th of September. Initially, I thought that the filter was set too strict with this last condition, but from this small group of stocks I noticed almost immediately one ticker, ITCI. The 2 parallel slanted purple lines which form the flag pattern are drawn fully automatically by the software. To display them by default in the chart, choose the overlay ChartMill flags in the chart settings as I already illustrated in the beginning of this video. I added ITCI to my watch list and 3 days later it looked like this. It remains a wonderful bull flag pattern, but I still don't see any confirmation of a breakout that finalizes the bull flag pattern. One thing I did notice was the volume that went along with the up move that day. So what do we have till now? We have a rising trend with some big white candles. The buy volume is bigger than the sell volume, and the sell volume in the flag stays low. So the only thing now is waiting for a confirmation breakout. The confirmation move occurs the following day. The price rose by more than 3% and closed just below the high of day. Moreover, the closing price was clearly above the bullish flag pattern, which confirmed and completed this pattern. So next step is a no-brainer, a buy setup above that last candle. Unfortunately, there seemed to be another problem: a horizontal resistance level very close to the current closing price. Another day and no breakout, but a narrow doji candle accompanied by heavy volume just below key resistance. This sounds promising. The following day, ITCI rises more than 2.5% and the closing price was just above resistance. We now have 2 confirmed price patterns, a bullish flag pattern in a cup and handle chart pattern. It's time for a buy setup just above that last candle. A stop loss below the last swing low is rather defensive and may be suited for the long-term trend traders. The shorter, more aggressive stop is more short-term based. The first real target for this setup is situated at the previous high, at around $44.5. And at the time of making this video, the chart looks like this. Knowing when to buy is one thing. Knowing how much you are allowed to buy and what your maximum loss will be if you get stopped out are additional essential elements for any individual trade. ChartMill can calculate this quickly and fully automatically with the easy-to-use position sizing tool. The software calculates how many shares you may buy based on your available trading equity. For the bull flag trade in this video, let's take a trading capital of $25,000 with a maximum risk percentage of 1%. ChartMill will now calculate how much shares you can buy based on your entry at 35.72 and an initial stop loss level at 32.28, which is the defensive stop loss. The position sizing tool gives a warning if the stop loss is less than 2 ATR. In this case, the defensive stop loss is at 2.66 ATR. The potential risk reward for this position is about 2.55, which is not bad at all. If the more aggressive stop is used at 33.84, then we do end up below the intended 2 ATR value, in this case at 1.44, and that is why a red warning cross is visible next to the stop distance ATR value. You can find an extensive article about the use of this position sizing tool in our documentation section, and I'll add a link below in the description. With a more aggressive stop loss, the risk-reward ratio rises to nearly 4.7, and you could argue that in this case the more aggressive stop loss was definitely the better choice. But keep in mind that the information on the chart you are looking at right now wasn't visible at the time of the entry, so a defensive stop loss certainly remains a well-considered choice. Actually, the approach is pretty much the same. Even as a day trader, it is best to wait until the pattern is fully established before taking action. This is a 5-minute chart. The green long candle is the opening candle on the date of September 21st. As seen on this intraday chart, an ascending triangle pattern was visible. The price immediately breaks through horizontal resistance with lots of momentum. This is quite noticeable by the fact that this is a huge green candle that closes strongly above the horizontal resistance. Just like the breakout from the bull flag pattern, it is tempting to open a long position during the breakout. And as a short-term trader, this is certainly worth considering, but keep in mind that you have no confirmation of the breakout until the candle closes above it. In this case, it turned out well and the position was never in any danger. It is nearly impossible to give a one-size-fits-all answer to that specific question. As a scalper, you will, hopefully, manage your positions in a completely different way than as someone who wants to profit from the upward trend for as long as possible. So here are a number of options for you to consider on the daily chart. Just one piece of advice I would like to share with you. Take the one that best suits your trading style and stick with it. There are no better or worse ways. The key to success in this area is consistency. The main distinction you need to make first and foremost when determining your stop loss is the following. Are you going for a set target price or do you want to hold a position as long as the trend lasts? If you prefer a price target, it's pretty simple. The moment you enter your buy and stop orders, a sell limit order is created at the same time which is set at your target price. You can rely on a risk reward of 1, 2, 3, etc. Or you can simply look at the next resistance level and place your target price just below it. In the second case, there are numerous options, but in the end it always comes down to adjusting the stop loss in your favor based on the price movements. The only rule you should never forget is that you may never change the stop loss to your disadvantage. Using a simple moving average, as soon as the first candle closes below the simple moving average, move the stop loss just below the low of that candle. In this example, I've used an SMA 20, but if you want to give the price a little more room, you can opt for an SMA 50. A trend line. As soon as the first candle closes below the ascending trend line, move the stop loss just below the low of that candle. Using swing points, higher highs and higher lows. As soon as a new higher high is established, move the stop loss to just below the most recent higher low. An ATR based stop. ChartMill allows you to place an average true range stop directly in the chart as a reference. You can choose to use 3, 4 or even up to 5 times the ATR value as the stop loss level. The stop is effective immediately once the price falls below that stop loss line. To set this ATR stop, place the cursor on the price level where you have set the initial stop loss. Then right-click and the following menu appears. Select the 3, 4 or 5 ATR stop and select a color. If these settings fail to appear on the chart, click once on the magnifying glass at the top right of the chart and then repeat the action. A 5 or 7 price bar pattern stop. The stop price is moved up every time a 5 or a 7 bar pattern is discovered. To set this stop, place the cursor on the price level where you have set the initial stop loss. Then right click and the following menu appears. Pick the appropriate stop loss and a preferred color. Well, we've reached the end of this episode, so in a nutshell, flag patterns, like other technical patterns, are ideal tools to time your entry in the market, but merely recognizing the pattern on a chart, however, is not a free ticket to open positions blindly. As has been shown in this video, there are numerous other elements that must be considered in order to be retained as a valid pattern. Now, ChartMill let you screen for bull or bear flag patterns on a daily or weekly basis, so you don't have to waste time manually searching for setups. Select the best low risk setups from the list provided by ChartMill, based on the points explained in this video, and make sure your entry, stop loss and position management are on point. Thanks for watching. Trade safe.